Ray Dalio grew up in a middle class family in Long Island. His father was a jazz musician. They were not wealthy. He had no connections on Wall Street, no family money, no trust fund, no leg up. He started Bridgewater Associates out of a two-bedroom apartment with nothing but a telephone and an idea. Today it manages over $150 billion and is the largest hedge fund on earth. But here's what Dalio says about all of that: the money was never the goal, and the path to it looked nothing like what most people are being told to do. Today, Ray Dalio gives you his honest, unfiltered advice on what it actually takes to build real wealth. Not the polished version, the real one. Let's go.
I am going to be honest with you in a way that most people in my position are not honest, because I think the financial advice most people receive is not just incomplete, it is actively misleading in ways that keep intelligent, hardworking people from building the wealth they are capable of building. So let me tell you what I actually believe, what I have actually seen work across 50 years of investing, across every economic cycle, across every kind of market condition, not the sanitized version that gets packaged into best-selling books and keynote speeches. The real version, the one that comes from building something from nothing and watching most of the people around me, people who were smarter, better educated, better connected than I was, fail to do the same. The first thing I want to say is going to sound almost offensive given the context, but I mean it with complete sincerity. If getting rich is your primary goal, you will almost certainly fail, not because wealth is unachievable, not because the system is rigged against you, but because wanting to be rich is the wrong objective. And when you are pursuing the wrong objective, every decision you make is calibrated toward the wrong outcome. You chase returns instead of building systems. You take risks you do not understand because the upside looks exciting. You make short-term decisions that feel like progress but are actually destroying the foundation of long-term wealth. You confuse the appearance of success with actual success, and eventually the market, which is the most brutally honest feedback mechanism ever invented, shows you the difference. The people I have watched build genuine, lasting, generational wealth over the course of my career were almost never primarily motivated by the money. They were motivated by something else, something that made them willing to do the work that most people are not willing to do, something that kept them in the game through the inevitable periods of loss and doubt and failure that come for everyone without exception. Let me tell you what that something was for me. And then let me tell you the practical things, the actual mechanisms that translated that motivation into the outcome, the thing that actually drives lasting wealth, and it is not what you think. I was 12 years old when I bought my first stock, Northeast Airlines. I bought it with money I had earned caddying at a local golf course, not because I wanted to be rich, because I found markets fascinating. The idea that you could study how the world worked, how economies functioned, how businesses competed, how human psychology drove prices above and below their rational value, and that you could translate that understanding into a number that went up or down on a ticker tape. That was captivating to me in a way that had nothing to do with the money the number represented. That fascination was the real foundation of everything I built, because fascination does not burn out the way ambition does. Ambition is exhausting. It requires constant external validation. It peaks and crashes with the market. It makes you desperate in downturns and reckless in upturns. Fascination, on the other hand, is self-sustaining. It makes the work feel like the reward. It makes the losses interesting rather than devastating. It makes the years of study and failure and refinement feel like exactly what they are, the education that the outcome eventually repays. I did not build Bridgewater because I wanted to manage $150 billion. I built it because I wanted to understand the economic machine as deeply as it could be understood. I wanted to build the most accurate model of how the world works that had ever been built. The wealth was a byproduct of the obsession. And I believe genuinely, based on everything I have observed across 50 years, that this ordering matters more than almost anything else in determining who builds lasting wealth and who does not. Find the thing you are genuinely fascinated by that also has real value in the world. Pursue it with everything you have. Build expertise so deep that the market cannot ignore it. The money follows the expertise. It almost always does, but it almost never comes first. And people who are primarily chasing the money spend their entire careers just behind it. The mechanism, how wealth is actually built. Now, let me be practical, because fascination without mechanism is just an interesting hobby. And I have watched plenty of fascinated, intelligent, hardworking people fail to build wealth because they were missing the specific structural things that convert genuine expertise into financial outcomes. The first mechanism is so simple that most people dismiss it. You must spend less than you earn by a significant and intentional margin, not by a little, by a lot. And you must do it consistently, not just in the years when discipline feels easy, but in the years when it feels like deprivation, when everyone around you seems to be getting richer faster, when the temptation to keep up is loudest. I grew up in a household where money was managed carefully. My father played jazz. We were comfortable but not wealthy. The habit of living within your means was simply how life worked in our house, not as a sacrifice, but as a basic operating principle. And when I started Bridgewater from my apartment in 1975, with essentially no capital and no clients, that habit was the thing that kept me alive through the years when the business was not yet generating enough to sustain itself. The gap between what you earn and what you spend is not just savings, it is optionality. It is the ability to invest when opportunities appear. It is the ability to survive downturns without being forced to liquidate at the worst moment. It is the buffer that separates the people who can make rational long-term decisions from the people who are forced to make desperate short-term ones. And desperate short-term decisions are how wealth gets destroyed faster than almost anything else. The second mechanism is understanding what money actually is and how it actually grows. Most people think of money as a number, a score, a measure of how well they are doing. This is the wrong mental model entirely. Money is a tool, and like any tool, its value comes entirely from how intelligently you use it. Money that sits in a savings account earning 2% while inflation runs at 4% is not being preserved. It is being slowly destroyed. This is a mathematical reality that most people understand intellectually and ignore practically. Because the savings account feels safe, the number does not go down. The destruction is invisible. It happens in purchasing power rather than in the balance displayed on your screen. And human beings are wired to fear visible losses far more than invisible ones. The only way to build real wealth is to put money to work in assets that generate returns above inflation over time. Ownership stakes in productive businesses, either directly through entrepreneurship or indirectly through equity markets, are the primary vehicle through which this has been done throughout history. Not the only vehicle, but the primary one. And the mathematics of compounding returns over long periods of time are so powerful that they dwarf almost every other factor in determining long-term financial outcomes. The compounding truth that will change how you think about time. I want to talk about compounding in a way that goes beyond the standard explanation, because most people have heard the compounding lecture. They understand intellectually that returns on returns create exponential growth over time. And then they make decisions that completely contradict that understanding, because the day-to-day experience of compounding is so invisible and so boring that the intellectual understanding never translates into felt urgency. Here is the thing about compounding that most explanations miss. The power is not in the rate of return, it is in the length of time. A 10% annual return held for 40 years produces an outcome that is not twice as good as holding it for 20 years. It is approximately 6 times as good. The relationship between time and compounding outcome is not linear, it is exponential in a way that makes the early years feel pointless and the later years feel miraculous. This means that the single most valuable financial decision most people can make is not finding the best investment. It is starting as early as possible and stopping as rarely as possible. Every year you delay beginning is not just 1 year of returns lost, it is the compounded value of every subsequent year that those returns would have generated. The cost of waiting is not visible in year 1. It becomes visible in year 40, by which point it is too late to recover it. The corollary to this is the thing that destroys more compounding wealth than any bad investment decision. Interrupting the process, selling during downturns, moving to cash when fear is highest, switching strategies when the current one has a bad year. Every interruption to a sound long-term compounding strategy costs not just the immediate returns, but all the future compounding those returns would have generated. The market does not give you those years back. They are simply gone. I have watched this play out thousands of times across my career. Investors who started well, built a sound portfolio, and then interrupted it at exactly the wrong moment during the 2000 crash, during 2008, during the COVID panic of 2020, and gave back years of compounding in weeks of fear-driven selling. The market recovered. Their compounding never fully did because the shares they sold at the bottom were not repurchased at the bottom. They were repurchased later at higher prices after the fear had passed and the confidence had returned, and the gap between where they sold and where they bought back represented a permanent impairment of their compounding trajectory. I want to address something directly because I see it constantly and it frustrates me, not because the people making the mistake are foolish, but because they are often the opposite. They are smart, they are analytical, they are curious and engaged and genuinely trying to build wealth. And the very qualities that make them intelligent are the qualities that are working against them. The mistake is complexity, the belief that building wealth requires sophisticated strategies, that the right combination of the right assets at the right time, if you can just identify it, will produce results that simple, boring, consistent investing cannot match. This belief is almost always wrong, and the evidence against it is overwhelming. The majority of actively managed funds run by some of the most intelligent, most resourced, most experienced investors in the world, underperform simple index funds over long periods, not by a little, by a meaningful amount after accounting for fees. The research on this is not ambiguous or contested. It is one of the most replicated findings in all of finance. Why does this happen? Because intelligence in markets does not work the way intelligence works in most other domains. In most domains, more analysis produces better decisions. In markets, more analysis often produces more confident decisions, which is not the same thing. The additional analysis frequently confirms what the analyst already believed. It adds certainty to a thesis rather than genuinely testing it. And more certain investors tend to take larger positions, hold them longer when they are wrong, and pay more in transaction costs and taxes through more frequent trading. The simplest portfolio that a disciplined investor can maintain through all market conditions will, over 30 or 40 years outperformed the vast majority of sophisticated strategies deployed by people with vastly more resources and expertise. This is not an argument against understanding markets. Understanding markets deeply is what I have spent my life doing, and I believe in it completely. But there is a difference between understanding markets deeply and believing that you can consistently predict them better than the collective intelligence of every other participant. The first is wisdom. The second is hubris, and hubris in markets is always expensive. If I could sit down with a 25-year-old version of myself and give them the advice I wish I had received, not the advice that sounds impressive, but the advice that would have actually changed outcomes, it would be this: your single biggest financial asset right now is not money. You probably do not have much of it. It is time, and time is the one resource that you cannot earn back, cannot borrow, and cannot buy more of. Every year of compounding you give away by waiting, by spending what you should be investing, by taking money out of the market because it frightens you, those years are gone permanently. You will not remember exactly when they slipped away, but you will feel the absence of them clearly when you are 55 and your peers who started earlier are in a completely different financial position, not because they were smarter or luckier, but because compounding had more time to work for them. The second thing I would tell that younger version of myself, and this is the one that took me the longest to truly understand, is that your greatest returns will not come from the market. They will come from yourself, from the skills you develop, from the expertise you build, from the problems you learn to solve that other people cannot solve. Human capital, the accumulated value of what you know and what you can do, is the foundation on which financial capital is built. Invest in it aggressively and consistently, especially in the years when the financial returns on that investment are not yet visible. I spent thousands of hours studying markets, economies, history, and human behavior before Bridgewater generated the kind of returns that drew serious attention. Those hours felt like they were costing me time. They were actually building the only thing that would eventually make everything else possible. The third thing is the one most people resist hearing. You will fail, not might fail, will fail multiple times in ways that will feel at the time like they might be permanent. The question is not whether failure is coming. The question is whether you have built the psychological and financial resilience to learn from it and keep going. Every major advance in my thinking about markets came directly from a failure. The 1982 depression call that wiped me out. The specific trades that went against me in ways I did not expect. The clients I lost. The models that broke in conditions I had not stress tested them against. Every one of those failures was painful in the moment and invaluable in retrospect. Not because failure is good, but because the lessons that failure teaches cannot be learned any other way. The actual advice, simple, honest, and unglamorous. Let me bring this together with the most practical advice I can give you. Not because practical advice is all there is, but because the gap between understanding wealth and building it is almost always in the execution of simple things consistently over long periods of time. Start investing now, not when you have more money, not when the market feels safer, not when you have done more research and feel more confident. Now, with whatever you have, because the cost of waiting is real and it is compounding against you every month you delay. Live significantly below your income, not slightly, significantly. Create a gap between what you earn and what you spend that would surprise the people who know you. That gap is the raw material of wealth. Without it, nothing else I am about to say matters. Put your investments on autopilot. Set up automatic transfers that move money from your income to your investments before you have a chance to spend it. Remove the decision from your hands because the decision made monthly in real time will be made wrong too often by the emotional version of you that exists when markets are scary or when something shiny appears. Own a diversified mix of assets across economic environments. Do not concentrate everything in the investment that has worked best recently. That is the most reliable way to be in the wrong place at exactly the wrong time. Own equities across geographies. Own some real assets. Own some protection against the environments you are not currently expecting. Learn continuously. Read deeply. Not financial news, not market commentary. Books, history, the accounts of people who have navigated every kind of economic environment across every kind of era. The patterns repeat with remarkable consistency. The people who recognize them are the people who prepared by studying them when nothing urgent was happening. And finally, think in decades, not quarters. The version of you that will thank you most for the decisions you make today is not the version that exists next year. It is the version that exists in 30 years. That version is watching what you do right now. Every dollar you invest today, every year of compounding you protect, every temptation to interrupt the process that you resist. Maturity is the ability to reject good alternatives in order to pursue even better ones. Getting rich is not about finding the best opportunity. Every generation has opportunities. Every era has assets that will perform extraordinarily well in retrospect. The question is never whether the opportunity exists. The question is whether you have built the knowledge to recognize it, the discipline to capture it correctly, the patience to hold it long enough for it to deliver, and the resilience to stay in the game through the periods when nothing is working. Those four things, knowledge, discipline, patience, resilience, are not personality traits you either have or do not have. They are skills. They are built through practice, through failure, through deliberate study, through the accumulation of real experience in real markets with real money on the line. They cannot be shortcut. They cannot be purchased. They cannot be downloaded from a course or absorbed from a podcast. They are built over time, just like wealth itself. And the people who build them, the people who do the unglamorous, boring, consistent work of becoming the kind of investor who deserves the outcomes they are seeking, those are the people who end up on the right side of the compounding curve. Everything else is noise. Everything else is the market's way of separating the people who want to get rich from the people who have done what it takes to deserve it. Start now. Stay humble. Keep learning. Let time work. That is my honest advice. All of it. The part nobody tells you is that it was never more complicated than that.
50 years, $150 billion, the world's largest hedge fund. And Ray Dalio's honest advice boils down to things anyone can start doing this week, not because they are easy, but because they work in every market, in every era, for anyone willing to stay consistent long enough for compounding to do what compounding does. What do you think of the advice in this video? Do you think it will work for you to build wealth over the rest of your working life? Let us know in the comments below, and I will see you in the next one.